Imagine earning millions of dollars, but you can't spend it. You can't deposit it. You can't invest it. You can't explain where it came from. Because the moment you try, alarms go off. Authorities start asking questions. Investigations begin, and everything collapses. This is the paradox of illegal money. And this is where money laundering begins. Money laundering is the process of making illegally obtained money appear legitimate. It is the transformation of dirty money into clean money, not by washing it physically, but by disguising its origin so that it can move through the financial system without raising suspicion. Every year, trillions of dollars are estimated to be laundered globally. Drug trafficking, corruption, fraud, cybercrime, human exploitation, illegal gambling. All of these activities generate enormous profits. But illegal profits come with a serious problem. You cannot openly use money that connects you to a crime, because money leaves a trail, and if investigators follow the money, they often find the truth. That is why laundering exists, not just to hide wealth, but to erase evidence. The term money laundering became widely known in the 20th century when organized crime. Groups used cash-heavy businesses to mix illegal earnings with legitimate revenue. If a business claims it made more money than it actually did, the extra illegal cash blends in. Over time, the origin becomes harder to detect. But today, money laundering is far more complex than mixing cash in a storefront business. Modern laundering can involve international bank transfers, shell corporations, offshore accounts, digital currencies, trade manipulation, luxury assets, and complex financial instruments that move money across borders in seconds. To understand why laundering is necessary for criminals, you must understand how the financial system works. Banks operate under strict anti-money laundering regulations. Large deposits trigger mandatory reports. Suspicious transactions are flagged automatically by algorithms. Unusual patterns, like frequent transfers between countries, rapid movement of funds, or transactions inconsistent with a person's income, raise red flags. Financial institutions are legally required to report suspicious activity to authorities. Governments share financial intelligence across borders. Investigators follow digital trails. In today's world, moving money is rarely invisible. So criminals face a challenge. How do you move large amounts of illegal money without being detected? The answer usually follows a structured process that experts describe in three broad phases. First comes placement. This is when illegal money first enters the financial system. At this stage, the money is most vulnerable because it is closest to the crime. Physical cash must be introduced somewhere, often through deposits structured in smaller amounts, purchases of monetary instruments, or movement through businesses that normally handle high volumes of cash. The objective is simple: distance the money from the crime scene. Next comes layering. This is where the process becomes more complex. Money is moved through multiple transactions designed to confuse and obscure the trail. Funds may pass through different bank accounts, multiple companies, various jurisdictions, and even different currencies. Each transaction creates another layer of separation. The more layers that exist, the harder it becomes for investigators to reconstruct the original source. It is financial camouflage. Finally comes integration. This is the stage where the money re-enters the economy appearing legitimate. It might be invested in real estate, businesses, luxury goods, stocks, or other assets. At this point, the funds look clean. They have documentation. They appear to originate from lawful activity, and the individual can now use the money without drawing immediate suspicion. But laundering is not limited to traditional banking. In modern times, technology has transformed the landscape. Digital payments, online platforms, cryptocurrencies, and globalized financial markets have created new opportunities and new challenges. Cryptocurrency transactions, for example, can move across borders instantly. While they are recorded on public ledgers, identifying the individuals behind transactions can be complex without proper investigative tools. Online marketplaces and digital services can also be exploited to disguise the movement of funds. Another method involves trade-based money laundering. This happens when the value of goods in international trade is manipulated. For example, products may be overvalued or undervalued on invoices, allowing money to move across borders disguised as legitimate commerce. Because global trade involves massive volumes of transactions, detecting anomalies can be extremely difficult. Luxury assets also play a role. High-value items such as art, jewelry, collectibles, and real estate can store large amounts of wealth in compact form. The art market, in particular, has historically been criticized for its opacity, as private sales can occur with limited disclosure. Shell companies are another powerful tool. A shell company is a business entity that exists primarily on paper. It may not have real operations, employees, or products. However, it can hold bank accounts, sign contracts, and move money. When multiple shell companies are connected across different countries, tracing ownership becomes complicated. In some jurisdictions, beneficial ownership information is difficult to access, creating additional layers of secrecy. The global fight against money laundering has intensified over the past decades. International organizations have established standards requiring countries to implement reporting systems, transparency measures, and cooperation mechanisms. Banks invest billions in compliance systems designed to detect suspicious behavior. Artificial intelligence now analyzes transaction patterns to identify irregularities faster than humans ever could. Yet the system is a constant battle. Criminal networks adapt. As soon as regulators close one loophole, new methods emerge. It is a cat-and-mouse game between enforcement and innovation. The consequences of money laundering extend far beyond individual criminals. Laundered money can destabilize economies. It can distort real estate markets by inflating prices. It can finance further criminal activity. It can corrupt political systems. When illegal money flows freely, it undermines trust in financial institutions and weakens the rule of law. At its core, money laundering is not just about money. It is about power, the ability to convert illegal profit into legitimate influence, the ability to move unseen through global systems, the ability to hide in plain sight. But here is the deeper reality. Laundering exists because modern economies are interconnected. The same systems that allow businesses to expand globally, investors to move capital instantly, and consumers to buy across borders also create vulnerabilities. Complexity creates opportunity, both for innovation and for exploitation. The lesson is not that the system is broken. The lesson is that the system is human. And wherever there is money, there will always be those trying to manipulate its movement. Understanding money laundering is not about glorifying crime. It is about understanding how financial systems protect themselves and where they are vulnerable. It is about recognizing that transparency, regulation, and accountability are essential in a world where billions can move in seconds. Because at the end of the day, money tells a story. Where it came from, where it is going, who controls it, and money laundering is the attempt to rewrite that story. The question is not whether it exists. The question is how societies continue adapting to detect it, prevent it, and protect the integrity of the global financial system. Because in a world built on trust, the cleanest money is not just the money that looks legal. It is the money that truly is.